However, as I began to expand my knowledge, I realized that I could get identical, if not higher returns while playing it way safer by spreading out my money throughout different options. And over the last 6 years, that's what I've done. My portfolio today is now comprised throughout international and US-based index funds, treasuries, cash, real estate, and a little cryptocurrency exposure through a Bitcoin ETF. Sure, I don't get the crazy high returns that someone who goes all in on one thing might get, but I do get the downside protection for when the market eventually does turn around. I just think for any long-term investor, this is probably something you should be doing sooner than later. After that, number 6 is something I have definitely been guilty of, and that would be holding on to too much cash. Yes, I'll admit this is pretty much the exact opposite of everything I've already covered here, but funny enough, this could also lead to some of the biggest financial losses in the form of opportunity cost. Look, don't get the wrong idea, it is important to have enough cash on hand to cover a 3 to 6 month emergency fund, pay down margin debt as needed, and have enough left over to cover anything else that might happen. But there is a point where you keep too much cash to the point where it negatively impacts your entire portfolio. That's because over time, you lose value in 2 ways. 1, inflation slowly reduces the purchasing power of every dollar by 2 to 5% a year as the government prints more money into the economy. And 2, you miss out on the profits you would have made had that money been invested. Look, it sounds weird, but I've seen people lose more money staying out of the markets, waiting for a crash that never happens, than the other person who buys in at the very peak and then watches their entire portfolio evaporate 30% in a few months.